Hey everyone, today I want to talk to you about mortgage structures and the different ways you can do this to save yourself a lot of money over the course of your loan. Now before I get into any of this, I wanted to let everyone know I am not a professional on this topic. All this information is from my viewpoints and what I have researched. This is just meant for educational purposes so that you have an idea of what is out there so you can pick what is best for you. As right now, the popular topic is refinancing your home or even buying your first home, as mortgage rates are ridiculously low right now. Now there are a few questions you need to ask your mortgage provider before thinking about restructuring your loan. First, you need to know how your interest is compounded on your loan. Is it compounded daily or monthly? As most loans are compounded monthly. Also, is there an early payoff penalty? As many of these structures will get you in a position to pay off your mortgage early. You want to make sure you're not going to get hit with a penalty at the end of that loan. Now I'm going to run you through a 30-year fixed rate mortgage, which is what most people fall under and most people have. It's probably the most common mortgage out there. There is also a 15-year fixed rate. There is 30-year bi-weekly as well as 15-year bi-weekly mortgage payments, and also a bi-monthly. Now there is a difference between a bi-weekly and a bi-monthly payment. A bi-monthly payment really only helps you if your interest is compounded daily. The reason for this, if you pay your loan in halves every month, say the 1st and the 15th of the month, when you pay that loan on the 15th, that pays down your principal. Therefore, a lower principal balance has a lower balance that the interest can be charged on. Now, if your interest is compounded monthly, that principal pay down only happens once a month. Therefore, the bi-monthly payment does not help you. Now, with a bi-weekly payment, you're actually paying 26 payments over the course of the year. 52 weeks in a year equals 26 payments, which, after calculating that out, comes out to an extra payment over the course of the year. Now that last payment goes directly towards your principal. And by doing that, you're paying down your principal balance faster, saving yourself money on your interest. Now I'm going to run you through a couple examples on calculators, just so you have a really good idea of what I'm talking about. Now, for simplicity's sake, in these calculators, taxes, insurance, and down payment are not going to be added, as those vary from house to house, and depending, of course, on how much you put down on your loan. I'm going to show you the difference between a 30-year mortgage monthly payments and a 30-year mortgage bi-weekly payments. For this example, we're going to take out a $180,000 loan. I picked this because this is about the median home price for the county I live in. We're going to grow at a 3.5% interest rate at 30 years. So you see, with regular monthly payments, your monthly payment's going to be $808. And over the entire course of a loan at $180,000, you are going to be paying $110,000, almost $111,000 throughout the course of that loan. And with a bi-weekly payment, you are paying $404, which is half of the $808. Now remember, you will be making 2 extra $404 payments through the course of the year, which equals your 13th payment if you were on monthly. Now that money pays your principal down throughout the year, which lowers the interest you pay. As you see with the bi-weekly payment over the course of a loan, you would only be paying $94,000 in interest. So you're saving yourself over $16,000 over the course of a 30-year loan just by doing bi-weekly payments and making that extra payment every single year rather than doing monthly payments. Now here's your principal pay down, and through this you will see the difference, your standard, which is your 30-year mortgage, and your bi-weekly mortgage, year by year, how fast your principal gets paid down. Now by doing this, you are actually paying your principal down a little over 4 years early at 3.5%. That's where you're making up the difference. So now you see, by paying your principal down faster, how much it really saves you. Now let's take out that same loan with the same interest rate at 15 years. Wow, my monthly payments do go up to $1,286. So, a little more pricey. But just with monthly payments, you're seeing your interest drop dramatically, and you're only paying $51,600 over the course of the loan, rather than almost $111,000 over the course of the loan on that same exact loan amount. And with bi-weekly payments, the interest over the course of the loan ends up only being $45,800. And same as with your 30-year, you can look at your principal pay down year by year from your standard to your bi-weekly. And you're still paying your interest off a little over 2 years early. Now if you like what you hear so far, do me a big favor and underneath the video on the left-hand side, hit that thumbs up button until your principal payment on your mortgage goes down. Or until it turns blue. That works too. Now, a few things you definitely want to ask your mortgage provider before switching over to a bi-weekly payment or setting up a bi-weekly payment right off the bat. You want to find out if your payment is being processed by the company your mortgage is going through or a third-party company. If it is a third-party company, you will actually be charged an additional fee for setting this up that you were paying every other week. And in that case, you're actually better off paying additional on your principal every single month. So to make this set up just like a bi-weekly payment would be set up, and to get the same effect, for example, off of that $180,000 loan at a 3.5% interest rate on a 30-year fixed, your payments are around $808. So divide that by 12, and it comes out to being about $67. So as most mortgages now, you can actually just set this up online, pay an additional payment of $67 on your mortgage every single month, and make sure it is paid down towards the principal. By paying down your interest, it's not giving you the same effect as if you paid your principal down. This will in turn actually give you the same exact results as if you did set up a bi-weekly payment. Or if you do have those rare mortgage setups where your interest is compounded daily, it may actually benefit you still to set up that bi-weekly payment through a third-party source. You'll have to run the numbers on that to see if it makes sense for you. Whether you're in a mortgage right now and you're thinking about refinancing, or doing a cash out refinance, or even buying your first home, the rule of thumb is to be around 30% of your gross income going towards your mortgage, your taxes, and your insurance. That's just to be conservative, to not stretch yourself too thin. Banks will usually pre-approve you at a way higher level, closer to like a 43%, which most people can't really afford. Now, as you see in the 30-year biweekly, 15-year, and 15-year biweekly, you can really see how fast you're paying down your mortgage going through these loan structures. Something you need to talk to yourself about, or your family, whoever's involved in this big decision, as it is a huge life decision to take out a mortgage or even refinance, is can we live a little below our means to take out a 15-year mortgage and save yourself that huge amount you're paying the banks in interest? Or maybe even still set up that 30-year bi-weekly mortgage payment and pay down a little bit extra on your principal every month. And to make this way easier, set your payments up for auto pay so that you're almost guaranteeing yourself to pay that additional payment every single month. If you don't set it up for auto pay and you actually have to go in and put that $67 in every single month, like in our example, the chances of you doing that extra payment are pretty slim. Also, when refinancing or buying your first home, you have to think about closing costs. There are many costs entailed into buying a house, and you want to kind of shop around from bank to bank to find out which bank gives you the best deal between interest rate and closing costs. Now we're going to talk about down payments. Now, if you want to avoid PMI, which is private mortgage insurance, it's really an insurance that you're paying every payment to the loan provider as a high-risk loan. So anybody that puts down less than 20% on their loan will fall under PMI, which actually has 0.5 to 1% more on your loan until you get under that 20% equity in your house. If you can afford to save up and put down a 20% down payment, you're in a lot better shape than most. So you're probably thinking, well, wow, I really haven't heard of a lot of these different loan structures. And the reason is the bank makes less money. You saving money means the bank makes less money. So by digging in a little deeper and figuring out which option works best for you can save you a lot of money over the course of the loan, as you've seen through our examples. And just to really drive this one home, I want to run you through one more example. Now, credit score is huge when it comes to buying a home. If you have a 740 credit score or higher, you're going to get a premium interest rate more than likely. Now, just to really drive home how important credit score is, on that same $180,000 loan at a 5% interest rate instead of at 3.5, over 30 years, your monthly payment goes up to $966, and you're paying almost $168,000 in interest, nearly the amount you're paying for your house. And with bi-weekly mortgage payments, yes, you drop to just a little under $136,000, but that's still more than if you paid off a regular 30-year loan without paying any extra additional payments at a 3.5% interest rate. So as your credit drops below 740, the lower it gets, the higher interest rate you're going to be paying on your loan. And you will see, with the 5% interest rate and your principal pay down, between the standard and the bi-weekly, if you still did a bi-weekly mortgage payment at that 5%, you're actually paying off your interest over 5 years early. So you're still saving a lot of money on interest, but it's very important to get your credit score up before purchasing a home. So after watching this, I really hope it helps you a lot. And if you are in the position to buy or refinance your home, that one of these options can greatly improve your future. So if you like this content and content like this, then underneath the video on the right hand side, click subscribe. Hit the bell notification next to that, and you'll be notified every time I make a video in the future. Also, In the description below, I'll have a link to my Facebook page, which will have a more detailed description of all of these loan structures and some helpful tips when looking for a mortgage. Now, there are many other ways you can finance your home outside of what I've explained tonight, but I would be here all night if I went through them all. So remember, giving yourself a raise does not always mean that you have to make more money. Sometimes it's saving yourself money, lowering your expenses, or even just add an additional principal payment to your already existing mortgage. Then go ahead and give yourself a raise. I'll see you next time.